Hi, I'm Barry Fisher, Vice President, Broadtower Insurance Solutions. In my opinion, possibly the most overlooked and misunderstood aspects of long-term care insurance planning, ones that can lead you to the greatest sales success, is the tax treatment of benefits received and the deductibility of premiums paid for a long-term care insurance policy. First, health benefits from any traditional tax-qualified long-term care insurance policy, hybrid or linked product, are generally received tax-free. This is true of all policies that reimburse for incurred expenses. For policies that use an indemnity-style method of claims payment, benefits received in excess of an annual amount published by the IRS each year, about $100,000 in 2014, will be taxed as income unless the policyholder can show that the expenses they incurred exceeds this limit. The significance of the tax-free nature of long-term care insurance policy benefits assures the policyholder that they will have 100 cent dollars to pay for the care they need. This is a huge advantage over having to liquidate retirement assets that may be subject to shrinkage issues, such as a bad market, early withdrawal penalties, income or capital gains taxes. Long-term care insurance assures the policyholder and their family that a tax-free flow of benefits will be available to provide choice and quality of care. There's an equally important tax advantage available to businesses, business owners, and some individuals when it comes to paying premiums for traditional long-term care insurance. Here's an important point to remember. Many tax professionals are unaware of these tax rules and often overlook them, costing clients legitimate and valuable deductions. In creating traditional tax-qualified long-term care insurance policies, the Health Insurance Portability and Accountability Act, HIPAA, classified them as accident and health insurance, which means that, as discussed earlier, the benefits are tax-free, but the premiums are generally tax-deductible. Taxpayers may benefit from this deductibility based on their tax-paying or employment status. In broad terms, individual taxpayers benefit least from the deductibility of premiums. In order for them to do so, they would need to be itemizing their deductions. They would then be able to apply some or all of the premiums paid based on the age-banded limits annually published by the IRS to their unreimbursed medical expenses. If the total of their unreimbursed medical expenses exceeds 10% of their adjusted gross income, they may get some tax benefit from their qualified long-term care insurance policy premiums. An often overlooked exception includes individuals with health savings accounts who may use money in their accounts to pay for a traditional tax-qualified long-term care insurance policy. Again, the annual amount is based on the IRS age-banded limits published each year. This allows HSA owners to pay for long-term care insurance with pre-tax dollars. Tax-deductible premiums become even more valuable for self-employed individuals, which include sole proprietors, partners, and owners of S corporations. The good news for these entrepreneurs is accident and health insurance premiums are not considered income, and thus the premiums paid on their behalf by their company has no taxable impact on them. To the extent that qualified long-term care insurance premiums paid by the company for the business owner do not exceed annually published age-banded limits, there is also no income tax paid. Generally speaking, for business owners in their 50s and above, these age-banded premium allotments may meet or exceed the actual premiums paid. Finally, traditional tax-qualified long-term care insurance premiums paid by a company for their employees is 100% deductible. This is critical for two reasons. First, with more and more employers including qualified long-term care insurance as an employee benefit, it is good to know that the employee will not have a negative income tax impact on April 15th. And second, stockholder employees of closely held C corporations, anyone owning 2% or more of the company, are considered employees, not owners. Therefore, their premiums are 100% tax deductible and their benefits are tax-free. I can't think of a more valuable benefit for rank and file or key employees. Business owner and corporate premium deductibility may be the greatest incentive for new sales and remains a critical component of the long-term care planning conversation. As always, consumers should be advised to consult with their independent tax professional to determine how traditional long-term care insurance premium tax deductibility specifically works for them.